Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's get to Gina Martin Adams, of Bloomberg Intelligence, Chief Equity Strategist. Gina, how much complacency at this point is still left in the market?
Oh, I don't think there's too much complacency at all, Alix. It's pretty rare to see the VIX spike well north of 60, as we did on Monday morning, and not have a full washout in sentiment. And I think we did see that by the time we got to the point of Monday close. The VIX was above 30. The 14-day RSI momentum score for the S&P 500 was just at 30. That kind of oversold momentum and extreme pop in VIX has historically led to positive returns 80% of the time over the next 3 months. So we've generally sort of washed out a lot of the complacency. I do think that to the degree that valuations are still a little bit too elevated in tech, that may be a space where complacency still exists. And, frankly, as much as we nitpick at these company earnings, the earnings have been very, very strong. So there's not a lot in the earnings that you can say really sort of dismantled the confidence in the tech space. If there's any complacency, it might be there, but I'd say markets at large have gone a long way to pricing out any sort of elevated enthusiasm.
So I'm still trying to figure out what happened. Like, what happened Monday, Tuesday, and today? Sure. Was it technical stuff?
You forget Friday.
Friday, too. Yeah. Well, I wonder why I forgot Friday.
Let's get on the beach.
Because I'm on the beach. So is it a technical thing? Japan carry trade thing that people are telling me about? The Nikkei trading crazy? What was it?
I think it's predominantly about Japan, and you can almost one-for-one mark all the way back to the middle of July when the market started weakening as the yen turned made a significant turn in direction, right? So it's very much about an unwind of the carry trade. And then last week, when we did get final confirmation from the Bank of Japan that they were raising interest rates for the first time in 17 years, that created a lot of instability. That was then exacerbated on Friday with some relatively weak economic data in the U.S. So it's that spread in interest rate differentials between the U.S. and Japan that is really key to this market meltdown. That clearly widened substantially over the weekend. U.S. bond market starting to price for Fed ease, where the Japanese market is now starting to expect a tightening in Japan, created tremendous weakness in the currency markets, which then exacerbated declines in the equity markets. I mean, I think that there is a link between all of these markets that is very, very notable. When you have this carry trade in place for nearly 2 decades and it's starting to unwind, it creates some issues of forced selling, some liquidity issues broadly that generally impact the equity markets. And I think that's largely what's driven the instability. Thankfully, overnight, we did get some news from the Bank of Japan that they've committed at the very least not to tighten during periods of general financial market distress going forward. But, frankly, we are in a different path for central bank policy than we have been in the points in the past. So we're going to have to be on guard for bouts of indigestion as we adjust to this new normal.
All right, Gina, I've been doing the stock market thing for 35 years. I have no idea what's going on out there. Gina Martin Adams, she's a pro.
That was not helpful.
Exactly. I have no idea what's going on. Gina Martin Adams, Chief Equity Strategist for Bloomberg Intelligence, joining us there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix Steele, Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our rainy interactive broker studio right here in New York. Although I don't know if it's actually raining right now, but it doesn't look pretty.
It's dark.
It looks dark. It looks a little grim, looks a little dark. All right, let's go to the bond market for a moment. Because 4 years ago, those 20-year bond auctions were a thing of the past. But Treasury Secretary at the time, Steve Mnuchin, reintroduced those 20-year bonds in monthly auctions. Their sale, apparently, if you just do back-of-the-envelope calculations, tacked on roughly $2 billion a year in interest expenses. And now Steve Mnuchin's saying, you know what, guys? Maybe we don't need them anymore. Maybe they're too expensive. Well, here joining us in studio is Yashay, a Bloomberg Markets reporter. He is the lead on this story for Bloomberg. It's reading quite high. You guys should definitely check it out on the terminal or on Bloomberg.com. Yay, what is he saying?
He's saying, as you just said, just to kill it. It's expensive paper for the government to keep selling every month. It's almost like 1 trillion over the past 4 years they sold. And based on our calculation, based on the average yields of 10s and 30-year bonds, the government overpaid roughly $2 billion a year, and it adds up to $40 billion over the life of the bonds. So, if the government keep selling it, it's just really costs a lot of money for taxpayers.
Why? Why is it costing more money?
Yeah, because you are selling the most expensive bonds on the Treasury yield curve. You would sell the bonds cheaply, raise the money cheaply for the government if you sell the 10 years, for example. And the $2 billion doesn't sound a lot of money, just considering in the context of the government's spending is almost $7 trillion a year. So $2 billion is not a big deal in big scheme of things. But at the same time, it's not small money, right? We look at the budget of the government, it's roughly equal to the annual cost for running the national parks. It's also equal to the subsidy for the veteran housing. So it's real money.
Why did he like it to begin with then?
So the government, it's 2020, the government's looking for new ways to diversify their funding and try to raise a lot of money because it's pandemic. The government spending is really ramping up. And they try to find a new source of the funding, and they studied a lot of ways, including selling 50-year bonds or 100-year bonds. The government have a advisory committee. They try to convince that Mnuchin that it's not a good deal to sell really long bonds, 50 or 100-year bonds, because it's even more expensive. Nobody's going to buy it. So the Mnuchin took the idea and sell the 20-year bonds. Remember, in the past, as you mentioned earlier, the government sold the 20-year bonds in the 1980s, but it only lasted 4 years because they run into the same problem as we run now. There's no sufficient demand for the 20-year bonds, and at that time, the government also have the limit of how much long-term bonds they can sell with. So at that time, the U.S. Treasury decided to just abandon the 20-year bonds in favor of keeping selling the 30-year bonds. 30-year bonds has more demand, at least it looks like now, that because a lot of the pensions, insurance company really like these long duration, long interest-sensitive security to match their balance sheet liability. So, yeah,
so
here we are.
Why don't they, if it's more expensive selling the 20s, why doesn't the Treasury just not sell any and just auction off 10s and 30s?
Yeah, so the Treasury, in their debt management principle, they really want to make the debt issuance more predictable, more reliable. So once they start issuing new bonds, they want to see it stick for a while. So everyone have the same expectations. So you just can't turn it on and turn it off on a whim. So that's the argument for keep doing it. The other argument is that if we're looking down in the next few years, the deficit is going to continue grow very quickly, and they need every help from every part of the curve. Since you have already this new instrument, so they like to stick with it. And also that the argument is that if you don't sell the 20-year bonds, you have to sell more 10 years, 30 years, then you're going to increase the cost for that part of the curve as well. So that's the counter argument.
Are they issuing more front end or back end?
Yeah, so so there's some academic study, the most cost efficient way is sell in the middle of the curve, in the belly of the curve, like 5 years, 10 years. Anything beyond that, it costs a lot of money. But they also want a more diversified of a case. So if you sell, all of a sudden sell lots of the 10-year bonds in one auction, you could see that auction fared fairly poorly. And this is something they want to avoid. So that's the argument to just keep doing that, yeah.
These deficits are they're becoming a thing here.
Yeah.
I mean, the annual deficit is almost $2 trillion. That's per year, kids. That's double the level of just 5 years ago.
Yeah.
What does your bond market say about that?
Yeah, that's a lot of debate on that. We saw that last summer, the long end of the curve really kind of keep rising. Remember at that time the Fed was raising interest rates, so a lot of people were concerned that we don't have a sufficient demand for these bonds, and I think this is still the concern in the markets. This talk of bond vigilante, it become a thing nowadays, that the idea that we are going to have a buyer strikes at all these auctions, because think about it, some of the foreign investors, especially the central bank in China, Japan, they are not coming to the U.S. Treasury market anymore, and it's really the private sectors are buying all these bonds, and they're very price sensitive. They want to buy the price. They're not going to buy the price that's really low. They want to be compensated for the risks. So there's a term in the bond market called a term premium. This is how much actual compensation you wanted for holding the long-term bonds. And we see it backed up a little bit over the course of the year, but now there's recession concern in the market, especially over the last couple of days. That term premium is capped at bay at the moment, but at some point has to be some confrontation between the markets and all these supply coming to the market.
At some point, totally. All right, Yeshe, thanks a lot, Yeshe. He's Bloomberg Markets Reporter. Definitely check out everything that he writes, because that's where I learn all my stuff. Just thank you very much for all your hard work and your writing.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Let's get more to the equity moves. Lyft also moving in the market. Airbnb, though, just really struggling. Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst, joins us on Airbnb. So is this Airbnb misjudging something, or is this just the U.S. consumer surprisingly slowing?
I think with Airbnb, the biggest concern has been the saturation in their core market. And, we are coming off of pandemic where the tailwind was behind them in terms of people traveling more. But now everyone realizes that their room night growth is tapering off. And the reason why it's tapering off is because they are highly penetrated in their core markets, whether it's in the US, Europe. And with any marketplace business, you got to grow supply. If you're not growing supply, then it becomes a problem, because then your demand is sort of limited by how much supply you can grow. So what they told us last night is they're going to spend more in terms of acquiring new supply outside their core markets in Latin America, in Asia Pac. And there will be ROI down the line, but for the next 2 to 3 quarters, they're going to be growing mid-single digit. And that's where I think when you're trading at 8-9 times sales, the highest valuation, you get this kind of response.
Alex, it's like we're surrounded here in our studio by these BI analysts. We got Mandeep, we got Jonathan Palmer on the healthcare.
I'm taking notes.
It's almost like there's not a management team in there keeping tabs on where all the analysts are for BI.
Because they're all here. We make them come here.
No, I think most of the analysts are on the beach at the moment. I mean, most of the management team. All right, so Mandeep, Airbnb, to me it feels like we're just kind of getting back to a new normal. I mean, if I like this story and I like the concept, I buy this stock on the weakness. What are some of are people concerned about the model per se, or are they just saying, hey, I just don't like the comps, I don't like the numbers I'm seeing?
Yeah, it's more about the estimates getting revised lower.
Okay.
So if you were hoping you will see upward revisions, that's not happening with this stock. And the reason that's the case is what they told us last night is, even though they are talking about new products, rooms and experiences, nothing is adding in terms of the incremental top line growth or the margins. In fact, the margins would take a hit because they talked about expenses being on the higher side. So if you are looking for, a next 1 to 2 year investment, there isn't a lot to look forward to in the Airbnb story. And plus, there is a cyclical element to this stock. Given, the economy is slowing down, consumer spending is slowing down, they had the best tailwind in terms of Olympics, summer travel. Still, they guided to mid-single digit room night growth. So that wasn't music to investors.
Is the demand there still?
Demand.
That's the other side, right?
So if you look across the board in terms of how the travel marketplaces have done, Booking, Uber, Lyft, every company has suggested that they are seeing some softness. Now, nobody is saying we are seeing recessionary trends. And when people pare down in terms of their travel spend, maybe they're not going to take 3 vacations, as opposed to they'll trade down and take 2. And same thing with type of Uber rides. They're not taking the most expensive. So there is that trading down that's happening right now, but nobody is calling for an outright recession yet.
Lyft. Is there any future for this company?
Can Lyft get a lift?
Can Lyft get a lift?
Oh, that was tough. I'm sorry.
At all.
I mean, scale is your friend when it comes to marketplaces, given how tough marketplace businesses are. And in Lyft's case, they need to partner with somebody who's rolling out autonomous vehicles, whether it's Waymo or Tesla. That's the hope. They need a part, or even in DoorDash.
That's not a good place to be. Now, what's management saying? Are they open to a partnership?
They are. They said their fleet network is the best to roll out these autonomous and robo-taxis, but clearly, we know Tesla's ambitions are they want to do it on their own. They don't want to use any of the intermediaries. So time will tell if Lyft will be partnering with them or
All right,
not.
that's amazing. I just can't believe how those two companies have diverged since their IPOs.
And it's reflected in the valuation.
Yeah,
I mean,
totally.
Look at Lyft's valuation.
I know, it's a monster. It's just a
10.
10x in terms of market cap. Mandeep Singh, thanks so much. We appreciate it. Technology analyst. Somehow he covers all those marketplace things. I think it's all kind of a scam. But I don't know. People love the Airbnb. My kids use them all the time. So,
oh, yeah.
So good for them.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's go to the other thing that I love, and that's energy. How to store energy is huge. And it's huge because if you want to diversify what energy you're using, like wind and solar, and even hydrogen, you need batteries, and you need really big batteries to be able to store it. Now, you can maybe do it for a couple hours, maybe a day or two, but doing that longer is proven really difficult and really expensive. And one company is trying to change that. The company is called Energy Vault. Now, it's SPAC'd back in 2021. Before it's SPAC'd, SoftBank was an investor. It's a Swiss startup, basically, that is trying to find different ways of storing energy. And the CEO joins us now, Rob Piconi, CEO of Energy Vault. He joins us from Switzerland. Rob, we appreciate the time. Can you just describe a little bit, in dumbed-down language, what it is that you guys do?
Sure. So we broadly focus on energy storage, and we focus on it with varying technologies and software. So we do shorter duration energy storage using lithium ion. We do long duration energy storage, meaning things that get sort of in the 6, 8, 12, even 24 hours. So full day types of storage with a unique gravity solution where we lift and lower blocks, or we'll shift water from different heights. And we also do ultra long duration, meaning multi-day storage using green hydrogen and microgrids.
Who are your customers, Rob?
Our main customers are first and foremost utilities. So we can sell directly to utilities, and we also sell to independent power producers. So the ones that will, for example, build out solar or wind and pair storage with that and have long-term contracts with utilities. And the third group are the large industrial users. So our investors include people like Saudi Aramco, BHP, the largest mining group in the world, and groups that are looking to make their own clean energy transition, or that have desires to make green hydrogen, for example, where you can make that using solar, an electrolyzer, but you need long duration storage. So because our technologies focus across a series of durations, we can actually meet a lot of those needs, and hence serving those three market segments.
So let's go back to the gravity storage solution thing. So this is from an article here at Bloomberg from a few years ago, but it describes it, and I feel like accurately and pretty well. An electric crane hoists up blocks of concrete and stacks them into a tower when power is plentiful. When power is needed, it uses gravity to take the structure apart brick by brick, and the weight of the descending blocks converts kinetic energy into electricity. That sounds really hard and complicated.
You know what? Gravity's been around for a while. I tell people it's not an idea; it's the law. So the whole physics of moving weights up and down has been around. But you're right, to do that in a way that's economical, to do that now with software where we can automate that entire process and dynamically look at the timing and dynamically accelerate that lifting and lowering. And also, we actually don't use concrete. So we avoid it because it's not really sustainable. It's one of the contributors, I think, 7 to 8% to greenhouse gases. So we actually have a material science team and worked with Cemex to use dirt and even waste materials like coal ash, even concrete debris, other things that would go into landfills. We can utilize that to make these large blocks that are 25 metric tons. So we try and avoid materials that are not sustainable to make those very same blocks.
So how is, I guess, your business changing to try to meet the changing sources and uses of energy these days?
It's a great question, and it is one of the challenges. It's definitely focused globally on countries wanting to achieve energy independence, and to do that, you need to be able to produce locally. Hence, our gravity solution, that's more long duration, of course, is ideal because you can produce most of that from local materials, local labor. I mean, it's construction, you're building a building. When you get to the short duration, which is most of the market today, and we know about lithium ion, so that's 2 to 4 hours, that's this time shifting people trying to manage. You're relying on the rare earth metals, which I believe, Paul, is what you're referring to. And that's where, through mechanisms like the IRA that was put in place in the US, they're trying to get that localized. And to deal with that, you have to come up with mechanisms to try to bring some of that production local as much as you can in terms of getting content. And that's been a big focus area, and of leveraging technologies like hydrogen, for example. Green hydrogen can be made sustainably. We're using that to back up the city of Calistoga in Northern California near Napa to provide a sustainable backup solution for 2 to 4 days that otherwise would have taken natural gas. So it's a combination of technologies you really have to use to solve this issue of reliance on either a few countries in the world or a few rare earth metals.
So if I just look at your stock, it's 93 cents. It's had a tough road since it's SPAC, right? I mean, clearly there was a lot of enthusiasm in the beginning. You had a nice pop, and then it's been really tough. In the last earnings for second quarter, the headline is revenue missing estimates. How do you manage this at this time? It's expensive to probably get all this done, even though the demand we know is still there.
Yeah, the demand is high, and the capital markets have been very challenging. In particular, if you go back to mid-2022, when the interest rate environment changed, and really fundamentally, I think the risk appetite for new emerging growth companies like ours really soured and changed. And for us, we focused on execution, and we had 148 million in our first year of revenue, 2022. Our second year, almost 350 million. So we more than doubled the size of the company. But at the end, investors are really focused on cash flow and minimizing risk. We've guided that that's going to happen next year. So in our first, I guess would be our third full year of revenue, that we're going to be cash flow positive and EBITDA positive. And I think until that happens, a lot of investors are on the sidelines. And what we can do is what we're doing, which is executing for customers and in different regions of the world. We announced new deals in Australia. We announced a large gravity project in Italy at a coal mine. And I think filling up that order book, Alix, is going to be fundamental. So investors see it's not about if, it's just about when. And as we fill that order book, then when that cash flow roadmap becomes very clear, which we're getting there to 2025, which is what we guided, I think then we'll see investors re-entering the stock.
In the interim, how do you fund your growth? Because I'm looking at the FA function, which gathers up all the analyst estimates. Still no positive free cash flow in sight here. So how do you fund that growth?
Well, we're in a great cash position. So we're well north of 100 million, no debt. Unlike a lot of the companies that pursued the SPAC route, they've done dilutive convertible notes and really at high cost, and also that hurt investors. We've done none of that. So we have no debt as a company, well over 100 million in cash, and we've reduced our burn rate to about 15 million a quarter. And in the meantime, we're ramping up now that revenue. We've guided 500 to 700 million between this year and next year. We do have a second half ramp, so that's not unusual when we're relying on EPC projects and the timing of these project starts. So that's from a cash perspective and being good stewards of the shareholder money and cash, we've actually done a very good job of that. And that's going to be playing out as we get into our growth period where we don't have a need to take on debt.
All right, Rob, we really appreciate it. Thank you so much. It's such an important space, and particularly with all the money flowing into it from private equity, companies, as well as governments, we appreciate that insight. Rob Piconi, CEO of Energy Vault, joining us on energy storage, which we definitely need. I think the question also becomes, we just had SunPower file for bankruptcy yesterday. It's a solar company based in California, and there were idiosyncratic issues to be sure. But what happens when someone else or whoever takes the White House in November? If it's President Trump, what areas of this gets rolled back?
Right.
Of the IRA? Maybe nothing. I mean, money's already been spent, but maybe something. And I think that must be very difficult to kind of manage in this business right now.
Right. And if you're an investor, do you want to stick around and while you have that level of uncertainty? You know? So we'll have to see. So certainly one of the industries that is paying close attention to the national elections.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix, Steele, Paul, Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so you can see us. YouTube.com, search Bloomberg Podcast. All right, commercial real estate, this is the way I frame it for everybody. 3rd Avenue, New York City, between Grand Central and our HQ here at 58th Street. When those buildings trade there, what are they going to trade at? I mean, what discount to the market? Bloomberg News did a great story on about a year ago saying that's really a risky area and it's emblematic of some of the problems in urban real estate. Lisa Nee joins us. She's a managing partner and head of real estate at EisnerAmper. I don't know, pick a building there, 750 3rd Avenue. When that thing trades, 10% discount, 20, 40, 50% discount, where is the market these days?
Yeah, hi, thank you for having me. So that's a really good question as to where the valuation sits and where people are willing to have the buyers and the sellers agree to that price. So 750 3rd Avenue.
Just to pick one out of the blue.
It wasn't my old office space. We currently moved. We're at 733 now, so it was our old space there. But looking at there and sort of looking, a Class A office building is going to trade differently than a B and C, and Manhattan's going to trade differently. So last year, if you would have had me here at this time, people weren't willing to make those price adjustments. And now, when you're looking at valuations, they're looking to make some adjustments. Now, how much of a decrease is really the key there. And looking at the leases in place too. Is it a long-term lease, short-term? And so the valuation is the key of what everything is going to be driving at. Now we finally have some buyers and sellers who are willing to bridge that gap, because the sellers are obviously waiting for the higher pricing. The buyers really want those deeper discounts that they're willing to do.
Do we have a market? Could you say, what I understand is Class A in New York or Boston or San Francisco is holding its value.
Correct.
And doing well. B and C, some of the discounts I'm hearing 50% plus.
Correct, and it's also how far are you along on that cycle? Where are you with your debt on that? And so, are the banks pressuring you? I mean, the banks at this point have been doing the pretend and extend, because they want to keep it on their balance sheet. Now they're looking at some of those B's and C's and looking to say, do we have to get those off our balance sheets? And they're pressuring the owners of the borrowers of the buildings to really go and do some due diligence and making sure to see how long they can last with those buildings and seeing if they really need to start getting those off their balance sheets. And so the banks are putting some pressure, regulatory reasons, the whole host of things, for those buyers to start looking and making some adjustments for the sellers.
We also saw, I think it was yesterday, Goldman Sachs took one of the big buildings in Times Square, and SL Green is going to be the property developer, but basically the guys who owned it defaulted on loans, and then banks had to take control of it. Are we going to see that over and over now, or is this going to be like a one-off?
So those are great headlines. That's what people want to read, is those headline stories. You're not going to read the portfolios that were able to work itself out through the news because no one cares, but those are happening. And so those behind-the-scenes stories are happening day after day.
How do they get worked out?
So the banks will work with the borrowers, and they'll put in some provisions in there for plans. They'll look at their rent rolls. They're making sure that they can make those payments and trying to make modifications within those debts to make sure that the borrowers really can can make the properties work. The banks don't want to see those headlines on distress. I mean, the banks don't want to go out of business, so they really want to make sure that they're working. And if they can make the cash flow work, they are going to work to modify those debt instruments for the lenders, or for the borrowers, I should say.
You know, I have yet to have, or we have yet to have, because we focus on commercial real estate. Maybe we think about office too much, and we think about New York City, San Francisco office too much, because commercial is so much broader. But I want the person to come in here, maybe it's a family business, been in New York real estate for 150 years and said, we're done. Too many of we had B and C buildings on 3rd Avenue, and the banks are forcing us, and we're only getting 50 cents on the dollar. My 150-year family business is done.
Well, we never want that to happen, right? So we want to make sure we're working. It is not happening. Most of those are very lower. They're low leverage. We've been holding those buildings for a long time, and those are smart cash flowing assets. And so they've been working those assets for quite a long time. You're not going to see a flood of deals. You're not. You're going to see the here-off bigger deals that you're going to be able to read about in the paper. But the floods that people were waiting for with all the capital to come in and rescue hasn't happened yet. And
No.
Have we hit the bottom? You know, I was away with a bunch of really, really smart owners and operators last week, and they couldn't agree if we've hit the bottom yet. And so it's just trying to figure that out.
So to that point, I guess it's a twofold question. One, why haven't we seen this flood of defaults like we were all kind of waiting for? And if we imply it's more on like a rolling basis where there's going to be these one-off buildings, et cetera, one-off deals, how long can that last for? Forever.
Great question. Wish I knew most of that, but again, it's part to deal with what the banks are willing to tolerate and how they can go in and do the modifications from a cash flow perspective. What people also are talking about is when you're looking to go in and purchase those deals and bring in the distress capital, the distress isn't there, so it's really not as dire. And so really getting the people to understand what the valuations of those properties are and wanting to infuse capital to make those properties work. And so I think we're going to keep seeing the one-off for a little bit. Until we've really hit that equilibrium where the buyers and the sellers can, and we're almost there, can start making some real meaningful trades.
What are the good stories out there in commercial real estate?
Oh, that's nice.
There's a lot of good, thank you. There's a lot of good stories. So industrial's doing really well. Data centers are hot. Hospitality has come back. Hotels, great.
Yep.
People are traveling and doing that. You know, maybe a little bit nervous about consumer spending, people with that fear and what's going to happen with the report that just came out. But hospitality industry is doing remarkably well considering where we were, a few years ago. So there are some great stories and there's some great opportunities, but in every asset class there's always a great opportunity for a great property with a really good vision. Why not take a great opportunity for that? So there are some exciting moments in commercial real estate.
So Paul has a 6% or over 6% mortgage rate, right? Yeah, straight up 6. So the big question is when does he refi? And he's like in the 5s, he'll consider it. I'm guessing it has to be in the lower 5s for you to really consider it. What kind of Fed cutting cycle do we need for things to make a lot more sense in your world?
So we're all anticipating, we talked about this before the session, we're all anticipating about 50 basis points in September for the Fed to reduce. We saw an alarming what people wanted an emergency, which is not going to happen. Again, the refinance is much different than the buyer market. So that refinance, I'm not sure Paul's going to get where he wants to go so quickly. But what should happen is that hopefully for people who are looking to sell, with the lowering of the interest rates, it'll make it a little bit easier for the buyers to come in and purchase those assets with respect to home building. Now remember, there's a lot more inventory now, believe it or not, than there were a year ago. There's been a surge recently of used homes, which are the homes that we've all lived in, and the home builders are having a little bit more of an influx of inventory for new units. What's interesting though, is there was a study done for the median home purchase. The disparity now between rental and that mortgage payment is still $1,300 a month. 10-year average was $300 to $400 a month. So we got to get that a little bit lower to be able to make a meaningful difference there.
So are banks lending, like if I'm in Poughkeepsie and I want to build a office park or maybe not an office park, probably like just a warehouse or something, will my local bank lend to me at reasonable terms?
The regulatory is making it harder. It's making it harder for them to go on their balance sheets and do it. Creative financing is a little bit more. So whether it's a debt fund, and even in the insurance companies aren't running to do those lends. Seller financing has really had an uptick in those types of projects. Again, that's land and you're building a warehouse. If you're renovating an existing, you might get seller financing. But the debt funds and some, believe it or not, those families that we spoke about, they're looking to do some creative financing too for people in the real estate space. So it's going to be your debt might not look the way it had historically, but there is money out there for those investments.
All right, Lisa, really great stuff. Really appreciate that perspective. Please come back. Lisa Nee, managing partner and head of real estate over at EisnerAmper. And funnily enough, we got Brookfield coming up with earnings today. And just they were expecting deal activity to pick up now that central banks are going to be cutting interest rates, and that they think that there'll be some large-scale transactions that happen and they're able to exit some of their investments. But that's like a behemoth, and they're an asset manager. So that's a whole different kind of bag of chips.
I've seen them walk away from, I mean, some of the big names. Like, I would just think from a reputational perspective, I wouldn't walk away from a building. I'd take the loss like a professional.
Like a thing.
Yeah, but
like
I mean,
something.
I mean, I don't know. But I guess they're these big funds and they can do it.
I guess. They do say that the real estate market it is improving. I guess the question is, like, how fast does it improve? And then where we kind of go from there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business and finance and economics through our lens of our Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries worldwide. We also love earnings. We love companies. We love to dig deep into some of the ones you may not have heard of. And for one of that is Nayax. It's ticker NYAX on the NASDAQ. It is classified as an other financial services. It's a vending payment solution company. The stock is up almost 5%. It reported earnings this morning. They reported a loss of about 8 cents a share on revenue of, as I go ahead and try and bring it up on my computer, on revenue about $78.1 million. The CFO joins us now. Sagit Manor joins us. Sagit, tell us more about your company. What do you guys do?
Good morning. So Nayax is the only global company in the unattended space. And what do I mean by that? You usually think about going into a store and paying with a cashier. We're exactly the outside of the store in the automated self-service. So think about as the vending machine, a massage chair, as you might see in the JFK airport, a laundromat, EV charging stations and whatnot. We are, as I said, the only global company in that space, selling to more than 120 countries. We have 1.2 million devices around the world with 85,000 customers. And we are very happy with the positioning that we have today in order to, because this space is early stages. So very excited.
So, Saki, talk to us about your relationship with the EV business. How does your technology interface with the EV charging business?
So we are actually selling our product in 44 different verticals. I've mentioned the vending machine, massage chair, kiddie ride, laundromat, parking, as well as the EV charging stations, which it's a very interesting vertical, and we're very excited about the opportunity there. So if you think about today, there's rarely payment device on an electric vehicle charging station. So what's happened is the user needs to download an app in order to pay for the electricity. And what we see right now in all markets is we see regulation are changing. We saw that in California. We see that in Germany, in the UK, and many more states like that, where you have to have a device, a payment device on those machines. So we see retrofit, and we actually work with all of the electric vehicle charging manufacturers, and we have the only solution today to have a card-present solution, as we call it, being able to pay with your credit card in a station everywhere you go.
How easy would it be, though, to have that disrupted? Like if I just go to the gas station, I can use any credit card I want, payment system easy. How quickly could that part of your business be disrupted?
Well, it's a great opportunity for us, right? Because even today, when you think about gas station, some of it you have to go into the store in order to pay with a credit card. So that was one. Same if you think about it, the same with electric vehicles, where instead of downloading an app, and by the way, sometimes you need 16 different apps because there's 16 different companies that allowing electric vehicle charging. So now you're going to be able, with the Nayax device, with our yellow Nayax device, to be able to pay with a credit card. So you have that opportunity. users and people that have an electric vehicle, they have an anxiety if they need to drive, especially in the US where it's so big, if you don't have enough stations out there. So now think about the ability to pay with your credit card is changing the entire business.
Sagit, how do you differentiate your company versus others like Block or Toast that are out there in the payment business?
It's a great question. So if you think about Toast and Block and Square for that matter, they're inside the store. So there we will be, we call it the attended space, where you have a cashier in front of you. We are actually in the automated self-service, as I said, where you actually outside, there's no one in front of you. So this is one. We also have the end-to-end solution. So you have the device, you have the payment, and you have the software. And so what we are providing every customer that we have, and as I said, we have 85,000 customers. Most of them, by the way, are small businesses where they cannot allow themselves too much of a hassle. We are allowing them two things: enablement of payment and to manage their business better. What does it mean? Manage their employees, manage their inventory, really look at the transaction value and be able to see how they can manage their business better.
I see. What are you hearing from your customers right now? We talk a lot about the state of the economy. We talk about companies investing or not investing. What are you hearing from your clients?
So I'll give you an example. In Q2, $1.2 billion of transactions went through our devices. But when you look at the number of transactions that happened, it's 600 million. My point is, at the end of the day, in our business, it's a very small transaction value. The average transaction value for us, it's $2. And in that space, we don't see much of a change in the economy like maybe retail is seeing. We actually continue to grow. This quarter, we grew 39% quarter over quarter with 47% increase on our recurring revenue. Our area, which is, again, the unattended space, is really in its early stage, and we don't really see any headwinds coming in. We haven't seen that for the last 4 years.
All right, Sagit, thank you so much for joining us. Sagit Manor, Chief Financial Officer for Nayax, the company, the electronic payments company here. You know, when you go to like the places and you self-serve yourself, you get a sandwich, you get a drink, and maybe at an airport, tap your card and ask for a tip.
Yeah, what's up with that?
So what do you do? Out of zero. But now it's harder to do that when it's somebody standing behind the counter.
It is true. And also, if they're making you stuff.
Yeah, but that's a tough one, the whole tipping, when I'm old enough to be set in my ways and say, I've never done that for 50 plus years. Why would I start now?
It's a fair point.
For the young folks, they're being trained to tip for things that we were not trained.
But if you think of like Starbucks, like you guys work hard, drink orders are complicated.
Yeah, I don't mind.
Should I give $1?
Yeah,
it is a new thing.
It is a new thing.
But like somebody just ringing up my stuff at a store, I don't know about that one. That's a tough one. But then I feel torn, and then you feel guilt, and then like, should you do that? But you know.
And then if you come from another part of the world where you don't tip, you're like, what?
What is that? Yeah. And I used to be a waitress, so I know the tipping feeling. So it's like, I feel you. I want to do that for you.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.